Welcome to the Coastal Business Channel. Today we're going to discuss the Sharpe ratio, but we are also going to touch upon the Sortino ratio and the Treynor ratio. We're mainly going to talk about the Sharpe ratio because it is automatically calculated in the portfolio analysis systems that I've used. So I've used one at Morgan Stanley, and now I'm using the one that's available at Raymond James, and they automatically calculate the Sharpe ratio. They do not provide the Treynor ratio or the Sortino ratio, nor have I seen those ratios on CNBC or Yahoo Finance or some of the Motley Fool or the other sites that I go to. I can calculate it on my own, but because it's not available anywhere else, I don't use it when I talk to my clients because they don't have ready access to it. For me to be able to publish that information and provide them with the Treynor and Sortino ratio, I have to go through my compliance, which is just an extra step to get things done. So mainly, the Sharpe ratio is the ratio that is used, and that's what I'm going to be discussing in this video more in depth than the other two. So the Sharpe ratio was devised by William Sharpe, who is a Nobel Prize winning economist. So he actually developed the capital asset pricing model. I will discuss that in another video, but he worked on the capital asset pricing model. He ended up getting the Nobel Prize in 1990, but then he developed the Sharpe ratio, and we were all more than happy to name it after him. I say we, I don't really mean me, but economists of finance and people were more than happy to name it after him. So the Sharpe ratio is the ratio that is called the reward to variability. So the numerator of the Sharpe ratio, so what's on top, and I will have a slide in here that's going to pop up instead of my face, but you'll hear me. It is the risk of the portfolio minus the risk-free rate. And by the risk-free rate, it actually could be the treasury, or you could have, like, let's say I want to know how Apple performs versus the S&P 500 or NASDAQ. So it can be a benchmark. It doesn't have to be the risk-free rate. So you're going to have the risk of the security you're looking at minus either the risk of the portfolio or the risk-free rate. And usually if you're looking at performance of a portfolio, it's going to be the risk of a portfolio, of a benchmark like the S&P 500. On the denominator, you are having the standard deviation. On the denominator, you are having the standard deviation of the returns over the same period. So if I'm looking at how has this stock performed over the last 10 years, I might be looking at monthly returns for a 10-year period or 120 months. So I'm going to have that standard deviation of the returns, like how have the returns been over 120 months. So what the formula looks like, and again, this is going to pop up, it is the risk of the portfolio minus the risk of the benchmark over the returns of the portfolio for 120 months, right? So how do we calculate the standard deviation? You could probably put it in an Excel spreadsheet and highlight it and click calculate standard deviation. Or what you can do is you take the return variance from the average return of each period, square it, and add it all up. So you're going to look at the return difference of the return of your stock versus the return of the portfolio. So that's your variance, right? And then you're going to square it and you're adding it all together. So you're adding 120 terms together. And then you are dividing it by 120 because there's 120 periods, right? And that's going to give you your standard deviation. No, it's not. Then you're going to divide it by 120. So you have the variance, right, squared, all added up, divided by 120, and then you're taking the square root. And that will give you the standard deviation. The Sharpe ratio is assessing the risk-adjusted performance of a portfolio. So your portfolio did great, but really, how great did it do based on the risks you took? Like, as you know, there is a efficiency frontier, and it's saying, okay, at this level of risk, I should have this return, right? But maybe you're at this risk, but your return is lower, right? If your return is higher, you're doing great, but if your return is lower, so am I earning the return that I should be given the risk that I've taken? And if I'm not, then the portfolio needs to be adjusted. So it's telling you, are you getting adequate return for the risk that you're willing to take? generally speaking, the Sharpe ratio is looked at historically. So it's looking at historical data. However, you can do it on forecasts. I would tell you, like, that's kind of hard, because if you get to kind of forecast out what it's doing, right, then it's going to be harder to kind of say, is this excessive risk? Because I can just have my return be higher. But so usually it's used for historical data. So how has this stock performed? How has this portfolio performed historically at the risk level that I'm willing to assume? If you have two portfolios, you actually would prefer your Sharpe ratio to be higher. So your Sharpe ratio is going to be higher if you're having excess returns over the risk. So a higher Sharpe ratio is generally always better than a lower ratio. The drawback of the analysis is that in the denominator, the standard deviation is based on a normal curve. A normal curve is, there's symmetry, right? So you have the symmetry in the middle and it's normal on the side. But what does the stock market do? There's a herd mentality, right? There's a herd, everyone's selling, everyone's buying. It is not a normal curve. So statistically, when you get into it, it actually should be, it should be using a different type of curve. But it's much easier for the standard person using the standard calculations and everything else to use a normal curve. So that's one of the drawbacks. I will tell you, it's a consistent drawback. So if you're comparing two Sharpe ratios, you're consistently off, right? So you have the same kind of negative. The other huge drawback is that the normal curve suggests, or I should say the denominator, and by means of using the normal curve, suggests that a positive and a negative return are equally desirable, right? It's not differentiating between, especially because they're squaring it, right? They're not differentiating between, okay, well, positive is good and negative is bad. They're just measuring that distance off of the normal curve. That's what a standard deviation does, right? Two standard deviations usually carry 80% of the information, but we don't want the negative, right? We just want the positive. So that's another one of the drawbacks. So that's another one of the drawbacks of the Sharpe curves. Now, Sortino and the Sortino ratio said, okay, look, that's a huge drawback, but we can fix that. Like, we can come up with a new ratio that actually ignores all the positive returns, because those are good and we like those. So we really just want to focus on, when do the portfolios underperform? When are they doing poorly? So that's what the Sortino ratio does. And its standard deviation just measures all the returns below the risk-free rate, right? Or all the returns below the benchmark, whichever one you're using. So that's where Sortino came in. It's unfortunate that his ratio isn't the one that kind of took off. And I think it's just that Sharpe's been in existence longer, because I personally believe that Sortino is really what you want to look at, right? I love when it overperforms, but if I'm comparing portfolios, which stock performs worse than the risk-free rate or worse than the benchmark more often, right? If there's a stock that performs worse than the benchmark or the risk-free rate, whichever one I'm using, 3% of the time, versus one that performs worse 50% of the time, I want to know that, right? I really want to know that, because my client that's taking monthly money out can't be having this stock that's performing below the benchmark, right? Its volatility is so big, it's creating a lot of issues for my portfolio and managing it. So Sortino is a really good one. Treynor ratio uses the portfolio beta as a denominator, and the portfolio beta is really, if the stock market's beta is 1. So a company that has a stock market beta of 1.1 is going to swing 10% more than the market, right? So like if the market swings this much, a beta of 1.1 is going to swing 10% more on each side. If this is the beta of 1 and of the stock market, and my company or my portfolio has a 0.75, well, now it's going to swing this much. So to me, that's actually another really good metric to look at, because I have a client that needs to draw down money and I can't have wild swings. So the Treynor ratio is saying, okay, well, the return that you're getting, let's divide it by their beta. And that's going to tell us the extra risk above the market, right? So that's another really, really good metric to use. So again, those are the metrics. Sharpe is the one that is used in pretty much any standard portfolio management software. I wish it was Sharpe. Sorry, I wish it was Sortino or Treynor. They have very, very good uses. I think Sortino is definitely, if everyone's used to Sharpe, I think that's an easier one to kind of transition to because it makes sense. We really want to look at the negatives. When is our portfolio not performing as well as the market or the benchmark or what have you? Anyway, thank you so much for watching. Please, I'm like bugging my eyes. Sorry. Please subscribe. Please like. Please leave comments. What do you want to learn about? What's helpful? What's not helpful? I really appreciate you watching. Take care.